In the last 48 hours, the part of the market almost nobody watches flashed a signal that should not exist in a world that claims to be well supplied. Not a rumor, not a meme. An official delivery report showed 2,514 silver futures contracts marked for delivery month to date. And on one single delivery day, the total hit 633 contracts. Each contract represents 5,000 ounces. 165 million ounces scheduled to move through the settlement machinery in a single day. Those are not casual numbers. Those are the kind of numbers that tell you someone is pulling on the physical thread, not just trading the story. What makes it stranger is the timing. In the same window those delivery figures were stacking up, the exchange raised margin requirements in silver, 5% on another. That is not a gentle tweak. That is the clearing system leaning on the brake. For years, the story has been that modern metals markets are too deep for delivery to matter, that there is always plenty of metal, and that delivery is basically an administrative footnote behind the real action on the chart. Here is the pattern interrupt that changes how you see the entire complex. When margin rises and delivery demand rises at the same time, it is not a normal volatility event. It is a stress event. It means the system is trying to reduce how many players can stay in the game precisely when more players are trying to finish the game in physical form. That combination is the market admitting, quietly, that the real constraint is not price discovery, the real constraint is delivery. Welcome to Signal and Flow, where we decode the plumbing before it becomes a headline. If you like calm analysis that follows settlement behavior, inventory mechanics, and institutional footprints instead of hot takes, stay with me. And if you're listening from somewhere far from the trading floor, comment where you are watching. Because geography and logistics are not side notes in a delivery story. They are the story. Now let's reconstruct what happened with forensic detail. The exchange publishes a daily document often referred to as the Issues and Stops Report. It is not designed to go viral. It is a table that lists which clearing firms issued delivery notices and which firms stopped them, meaning which firms took the other side and accepted delivery. In early February, the report showed a day with 633 silver contracts moving through this process, and a month-to-date tally of 2,514. The firms involved read like a roster of institutional finance. Global banks, large broker-dealers, and major clearing members that do not do paperwork for fun. On the surface, that looks like a routine settlement log. Under the surface, it is a record of who is converting paper claims into metal inside the system. When that record gets heavy, and especially when the names involved are not small speculative shops, it signals that the most connected players are behaving as if metal access is valuable enough to justify the operational work of taking delivery. At the same time, the exchange didn't just bump a number, it raised margin requirements sharply and shifted its approach so that margins were tied more directly to the value of the contract. Percentage-based margins scale automatically with price and can ratchet upward fast when volatility rises. In plain language, the exchange made it more expensive to hold silver futures positions, and it made that expense more sensitive to abrupt price moves. That change pressures the most leveraged participants first, which means it changes who can stay in the market during the exact period stress is rising. This is where the central contradiction appears. If the market is truly well supplied, if deliverable metal is abundant and easy to source, why would delivery demand be piling up among large firms, and why would the exchange feel the need to push out leverage right as delivery is being demanded? In a well-supplied world, delivery is boring. In a stressed world, delivery becomes the prize, and leverage becomes the risk. To see why, you have to separate the silver market into two overlapping realities. One reality is paper. That is futures, options, exchange-traded vehicles, swaps, and the huge universe of contracts that reference silver without moving a single ounce. The paper world is liquid, fast, and heavily leveraged. It can move billions of dollars of exposure in minutes. The other reality is physical: bars, coins, industrial feedstock, and vault inventory that can be delivered through the exchange system. The physical world is slow. It is constrained by refining capacity, transportation, vault rules, bar specifications, and the simple reality that you cannot teleport a pallet of metal into the right place at the right time. When those two realities are aligned, paper prices and physical availability reinforce each other. When they diverge, you get dislocations that look impossible if you only watch the chart. Paper can drop because leveraged funds are forced out, while physical remains tight because industrial users and inventory managers still need metal. Paper can rally because financial flows chase momentum, while physical premiums stay elevated because product form and location do not adjust overnight. The key is that the paper world can change instantly, while the physical world changes on schedules. This is not the first time the system has looked calm on the surface and strained underneath. The hidden pattern shows up whenever three things happen together: volatility spikes, margin rises, and physical settlement demand refuses to fade. That trio is the signature of a market where participants are no longer comfortable rolling paper promises forward indefinitely. They want closure. They want certainty. They want settlement. Think back to 2020. The world did not run out of precious metals in the geological sense. What happened was a breakdown in the chain between paper pricing and deliverable form. Refiners slowed. Transportation networks fractured. Metal was in the wrong locations and in the wrong bar sizes for specific settlement channels. The paper price could print, but the physical product many buyers wanted was not instantly available at the posted price. Premiums widened. Spreads blew out. The gap between what the screen implied and what could actually be sourced became the real market. Now go back further. In 2008, the crisis was not a shortage of buildings. It was a shortage of trust inside a leveraged system. Funding markets froze because counterparties stopped believing the paper representation of value. The instruments existed. Confidence did not. In 1998, when long-term capital management unraveled, the core issue was not that government bonds vanished. It was that leverage and correlation snapped together, forcing liquidation into a thin market. In each case, the warning sign was not a headline. The warning sign was stress in the plumbing. Here is the simple structure that repeats across decades. In 1980, the silver market experienced an extreme squeeze dynamic where leverage and deliverability collided, and the market response involved sudden rule shifts and forced deleveraging. In 2008, collateral constraints cascaded and forced selling dictated price even when underlying assets still existed. In 2020, logistics and form constraints made settlement mechanics matter in a way most people had never considered. In 2026, the same ingredients are resurfacing. Higher margin pressure, persistent volatility, and rising signals of settlement demand. Silver delivery stress fits that pattern. The playbook is familiar. First, volatility rises. Second, the exchange or clearing system raises the cost of leverage. Third, weak positions are forced out. Fourth, the remaining players consolidate exposure, and the ones who truly need the underlying asset push toward delivery or secure supply elsewhere. The final step is where the public notices, because price behavior becomes unstable and narrative pressure builds. Now let's talk about the players, because this is where the story is often told backwards. When people hear delivery, they imagine a wave of small buyers demanding bars. But the exchange delivery mechanism is operationally complex and capital intensive. It is designed for firms that can handle logistics, financing, and compliance. When large clearing firms are active on the side that accepts delivery, it suggests that the demand is coming from serious channels, industrial procurement, institutional inventory programs, or sophisticated trading strategies that value physical settlement. A firm can stop deliveries for multiple reasons. It might be taking delivery to meet client demand. It might be acquiring inventory to support market making. It might be settling an internal position it does not want to roll. Or it might be positioning for a future where physical tightness changes the economics of the whole complex. The report does not tell you motives. It tells you behavior. And behavior, especially repeated behavior across days, is the cleanest signal you get in markets. Now layer in the margin changes and the picture gets sharper. A margin hike is not an opinion about whether silver is good or bad. It is a risk control decision designed to protect the clearing system. Clearinghouses exist to prevent default cascades. They raise margin when price volatility increases, when correlations shift, or when they perceive a higher risk that one side of the trade cannot perform. Margin is a map of where the system perceives danger. When margins jump quickly, the system is saying, we need more buffer because the probability of disorder has risen. So what happens when margin hikes collide with delivery pressure? It creates a squeeze in the middle. Leveraged traders are forced to reduce positions. That can push futures prices down even if physical demand is strong, because the selling is mechanical. It is not a judgment about supply and demand. It is a requirement to raise cash. Meanwhile, the players that are less sensitive to leverage, or the players who actually need the metal, can use paper weakness to secure exposure more cheaply while still pushing settlement through delivery channels. The chart can look bearish at the exact moment the settlement data looks tight. This is the dislocation that confuses almost everyone watching from the outside. One data stream says weakness, another says tightness. And both can be true because paper markets move faster than physical markets and because forced selling is about financing, not about desire. Here is the part that almost nobody discusses in plain terms. Delivery stress does not require total inventory depletion to matter. It only requires deliverable inventory to be constrained relative to demand inside the settlement system. A shortage is often not a lack of atoms. It is a lack of accessible units that meet standards, sit in approved locations, and are not already pledged elsewhere. Metal can exist and still be unavailable at the moment it is needed. That is why the phrase real shortage is so often misunderstood. People imagine empty vaults. What markets usually experience first is a schedule problem, a form problem, a location problem. You might have plenty of silver in the world, but not enough in the exact bar type of the contract. specifies not enough in the right vault network, not enough that can be mobilized without disrupting other obligations. And when that is the constraint, the earliest signal is not a headline. The earliest signal is behavior. Now let's quantify what the recent delivery numbers imply, because numbers keep narratives honest. 165 million ounces, 57 million ounces. If you think in consumer terms, that might sound abstract. In industrial terms, it is not. Industrial users do not care about paper exposure. They care about feedstock arriving on schedule. A disruption of a few million ounces in deliverable form, concentrated in the wrong week, can ripple through supply chains. And when supply chains are already lean, timing becomes the difference between smooth production and costly substitutions. Now add the exchange's behavior. And when an exchange changes margin methodology, it is adapting to volatility, but it is also shaping who can participate. Percentage-based margins during volatile periods can behave like a throttle. They automatically tighten the system when prices swing. That means the market can experience a sequence where volatility triggers margin hikes. Margin hikes trigger forced selling. Forced selling triggers more volatility, and the system keeps tightening until weaker hands are gone. This is why a real shortage often looks like whiplash. It looks like a sharp down move that scares people away from the idea of tightness, while the firms that need settlement keep showing up in the delivery data. It looks like calm commentary about plenty of supply, while margin rules are tightened and participation becomes more expensive. It looks like a market that insists it is efficient, while the plumbing tells you it is managing stress and rationing leverage. To make the mechanism intuitive without drowning in jargon, imagine the market as a stadium with two exits. The first exit is wide and easy. That is the paper exit. You can enter and leave positions quickly. You can roll exposure forward. You can trade without touching metal. Most participants use this exit because it is convenient and because, in normal times, it works. The second exit is narrow. That is the delivery exit. It requires documentation, capital, and operational capacity. Only some participants can use it. When the crowd is calm, the narrow exit works fine because few people use it. When stress rises, more people want the narrow exit at the same time, because they no longer trust that the wide exit will guarantee access to metal when they need it. Congestion builds. The exchange does not want congestion at the delivery exit because congestion leads to failure, and failure leads to confidence loss. So it raises the price of being in the stadium by hiking margin. That pushes some people to leave through the wide exit. It reduces the crowd. It is crowd control. That is why margin hikes often coincide with sharp price drops. The selling is not always a vote. Sometimes it is an evacuation. Now zoom out to the backdrop that makes delivery stress more plausible today than many people assume. Silver is not only a monetary metal, it is an industrial input with expanding use cases across electrification, electronics, and solar. Demand growth in these sectors is real, but supply is slow. Mining output cannot be turned on like a faucet. New projects take years to permit, finance, and build. Refining and minting capacity are bottlenecks, especially for certain product forms. And inventories across many commodities have been run lean because the last decade rewarded financial efficiency over redundancy. There's also a geographic layer. Physical demand does not arrive evenly, it clusters. Manufacturing hubs pull metal according to production schedules. Investment demand pulses according to currency conditions and risk sentiment. When delivery stress shows up in an exchange settlement report, it may be reflecting a real-world pull that started weeks earlier in factories, refineries, and logistics networks. Now connect the dots between separate-looking events, because timing is the clue institutions rely on. First, a margin hike event produces sudden downside sensitivity in futures, showing you how dependent price is on leverage. Then, margin methodology shifts toward a percentage of contract value, increasing the system's ability to tighten quickly during swings. Then, delivery totals show a heavy cadence in silver, including a day with 633 contracts and a month-to-date total of 2,514. None of these alone is destiny. Together, they form a coherent story. The system is responding to volatility and settlement demand by tightening participation and managing risk in real time. If you want to understand institutional coordination, do not look for a secret meeting. Look for synchronized incentives, constraint-driven. Now we return to the dislocation, because it is the heart of why so many people stay confused. The first signal is the price chart. It can show sudden declines after margin hikes because forced selling is real. The second signal is delivery behavior. When delivery remains heavy, it tells you certain participants are not leaving. They are settling. They are converting paper promises into metal within the system. The narrative says silver is weak. The plumbing says silver is being pulled through settlement while leverage is being purged. Both can be true, and that is why simplistic explanations fail. The gap cannot persist forever because paper and physical are connected by arbitrage, but the connection is not instantaneous. Arbitrage requires capital, logistics, and confidence in rules. When volatility rises and margins increase, arbitrage becomes more expensive and more dangerous. That slows the repair process. Dislocations can last longer than people expect. They can become self-reinforcing, and they often end abruptly when a single constraint forces repricing, not because anyone wanted drama, but because the system finally hits a limit. So what does history suggest tends to follow when you see rising delivery stress alongside tightening leverage controls? There are three broad scenarios, and none require prophecy. They require observation. In the conservative scenario, the stress is episodic. A cluster of institutions needed inventory for a specific window. Delivery spikes, then normalizes, volatility fades, margins eventually ease. The system absorbs the strain without dramatic repricing, but the message remains. Physical settlement is not an afterthought and cannot be ignored forever. In the moderate scenario, delivery demand stays elevated across multiple cycles. Margins remain highs or rise again. Price swings remain violent, with sharp sell-offs after risk changes and sharp rebounds when forced selling exhausts. Premiums in certain physical products stay sticky. The market becomes sensitive to small disruptions in refining, transport, or vault flows. In this world, the chart becomes less about direction and more about the battle between leverage and settlement demand. In the aggressive scenario, delivery stress becomes chronic and confidence in easy settlement erodes. That does not have to mean a public default. It can mean rule changes. It can mean incentives to settle in cash. It can mean a widening basis between contract prices and the cost of sourcing specific deliverable forms. Historically, systems under stress often adjust rules before they admit shortage, because rule adjustments are a way to preserve continuity and buy time. Notice what is missing: a guaranteed outcome. The point is not a price target. The point is to recognize the conditions that have preceded major repricing events in the past, and to monitor the indicators that show whether stress is dissipating or building. If you want to stay grounded in data instead of emotion, watch a handful of signals. Watch delivery totals relative to typical months. Watch whether large clearing firms remain active on the side, accepting delivery. Watch margin levels and any methodology changes. Watch spreads between venues and product forms, because spreads are where dislocations express themselves first. Watch inventory classifications, especially what is truly deliverable versus what is merely reported. And watch volatility itself. When volatility stays high while delivery stays heavy, the system is still searching for balance. Now we come to the divide, and this is where attention separates from noise. Most people experience markets as charts and headlines. They see a red day and assume demand vanished. They see a green day and assume scarcity returned. But plumbing moves differently. Institutions live in the plumbing because their obligations live there. Supply contracts, hedging, programs, balance sheet constraints, and risk committees. The wealth gap in markets is often an information gap, not because the data is hidden, but because almost nobody bothers to read the boring documents that describe what is actually happening. Institutions tend to move first because they must. They have timelines and constraints. Retail tends to move last because retail consumes narratives after they become visible. That is not a judgment. It is structure. And it is why delivery stress is such a powerful signal. It shows what the system is doing before it becomes obvious on a chart. Take this as the core lesson. A real shortage begins as a behavioral shift, not as an empty vault photo. It begins when settlement becomes valuable, when leverage becomes dangerous, and when the exchange itself adjusts the cost of participation. The numbers we walked through, the margin jumps, and the delivery totals are not entertainment. They are the market writing a memo in plain sight. This is signal and flow, where we decode what matters before it becomes tomorrow's headline. If this connected dots you had not lined up before, you know what to do. And remember, the question is not whether stress signals appear. They always do. The question is whether you notice them while they still look like boring tables, or only after they explode into the price chart.